Ladies and gentlemen, good day and welcome to the Q3 FY22 earnings conference call of Thermax Limited, hosted by DAM Capital Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital. Thank you, and over to you, ma'am.
Thanks, Stephen. Good afternoon, everyone. I would like to welcome you to the Q3 FY22 earnings call of Thermax Limited. We have the management today being represented by Mr. Ashish Bhandari, Managing Director and CEO, and Mr. Rajendran Arunachalam, Group CFO and Executive Vice President. I'll now hand over the call to Mr. Bhandari for his initial remarks, post which we'll open up the floor for Q&A. Over to you, sir.
Good afternoon to you, Bhumika, and to everyone else that's on the call. Welcome back. I guess we have not spoken for a quarter now, and a lot has happened in these last 3 months. One part of the picture felt like deja vu again in terms of and I'm saying again because it seems like it's happening now for the 4th quarter in a row. But this particular quarter, we'll talk about what were things that we further did not anticipate on the commodity price side, which resulted in this margin drop, and we'll talk quite a bit about it there. On the commercial front, we continue to see strength in terms of overall ordering, even beyond a couple of these 1 or 2 big orders that we are showing. We see strength. Our base business has moved up a level, as you can also see from your numbers. The question now is whether it holds or continues to move ahead or potentially goes a little down as well. I think the trends are not entirely clear based on some slowdown that we've seen in December and January, but is that because of the Omicron wave working its way through and then the strength will come back? I think we'll see as we finish off the remaining 2 months of the quarter. Overall, I think most people that I speak with are continuing to be bullish on the CapEx scenario, and the budget has definitely helped. I do expect that with this, some of the more private expenditure will also start to make its move around. Internally, our focus continues to be on, in terms of the growth side, in terms of the green agenda, becoming more and more capable out here, continuing to push our products and services. The international bit, which hasn't resulted in as much success as would like yet, but continues to take quite a bit of time internally, making this a more digital company. And then, of course, right now, from an operations point of view, across the company, making sure that we work through some of these cost challenges relating to commodity prices, if we are able to manage those effectively. We've shared with you the analyst pre-read and the analyst presentation that covers the business, the trend, some of the highlights for the quarter itself. So I'll skip all of that and open the floor for questions so that we have more time for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Good afternoon. Thanks for taking my question. My first question is with respect to the large orders that are there in the pipeline. Last quarter, you had mentioned about a couple of large orders which can potentially come from the steel sector. Are you seeing that fructifying? Are you seeing any further large orders, both domestically and internationally?
Okay. See, I talked about large orders, and I said that many of these large orders are in the mix relative to government projects. Yeah, and the two that we have shown already, the FGD one from NTPC and this other one, which is not exactly a government project, but one that has been under discussion and has been bid long time ago, now going through its final bids and awards. Similarly, in the refining and petrochemical side, there are quite a few bids that we have made on which we are waiting for results to come by. Very competitive space, so very tough to say whether we'll win nothing, whether we'll win 1, 2, 3, we don't really know what can happen. So there's a bit of variance out there. In steel, we have had good success in steel. But the really big plants of steel, for the two big players who have announced those big projects, they won't show us for maybe another 3, maybe even 4 quarters.
Okay, so we need to wait for another 3 to 4 quarters for those orders to get fructified, you are saying?
Steel side, yeah. On all the rest of it, where I talked about oil and gas refining, which is the EIL, IOCL, HPCL, HRRL, of those related projects, those are already, they've been bidded out and are in work in progress. Internationally, we have 1 or 2 projects, but nothing like the old Dangote kind of really mega deals in the mix. We have quite a few 100 crore plus opportunities under discussion.
Okay, sir. Okay. And next comes in terms of, say, pricing and margins. So basically, with orders seeing a fair bit of pickup, are you seeing the pricing power for you coming back? In the sense, the pricing of your orders, are you able to improve the pricing given the fact that input costs have gone up and margins have been under pressure? So is there scope for improvement in pricing over the next 12 months?
I would say yes. And the challenge that we had, and this is a question that I'll answer for because others would have this question as well, is what hit us was not just commodity pricing, it was the rate and pace at which it went. Yeah, and specifically if I take our chemicals business as an example, where we had our pricing for certain commodities, especially for some of the ethylene dichloride, the methanol not as much, but definitely ethylene dichloride, caustic soda lye, fuming acids, all of them, they just in November, and these are all domestic buys. Yeah, the pricing practically doubled overnight. Within a period of 2 to 3 days, it was just that pricing it completely dramatically, it felt like it dramatically changed. And that was very difficult to pass on because we had already taken those orders. We did go through a big price increase in December on the chemical side. Interestingly, a couple of the global chemical majors, including, and some of it is public information, so Dow's also announced a big price increase. So I think, yeah, we are very open to increasing prices. We think we have some pricing power. It is just that the fact that it went through so suddenly in a way that we could not really pass on.
Got it. So, last time we were like close to double-digit margin was in FY17. So, do we expect such a margins in next year, or how much time would it take to reach such a kind of margins? Because this year, I think we will be ending up with 7.5% margins, if I'm right.
I think where you are, I shouldn't say the range is broad, but I think it's sufficient. I think that is something that we are internally at least seems like given there are only 2 months left in the year, I think that is fair. Long term, I think you can think of our businesses as at least 2 parts. Yeah, one part is the products and services, places, businesses that we need working capital for, and especially right now we will have to make some technology investments on the green side, invest in certain product capability, R&D, So those are areas where some money will go as well. But there overall, you would expect the margins to be higher overall. On the other side, we have got certain of our project businesses where it will be understanding the competitiveness of India will be tough to get the PBT at least to 10% margins. And tough meaning that is not something that we plan for as well. But these businesses run on negative cash flow we think are accretive from a value generation, cash generation perspective, and very integral to the overall Thermax story around being able to help our customers on energy sustainability. So I think we'll look at our businesses accordingly and not have a hard rule that every business needs to be 10% PBT or otherwise. But overall, should our margins be better than the 7.5% that we have? I also expect that is very much the aim. Yeah.
Got it, sir. Thanks a lot, sir. Thanks a lot for your answer.
Thanks.
Thank you. Next question is from the line of Pankaj Debrewal from Kotak Mutual Fund. Please go ahead.
My question was most likely on a medium to long term basis. We all acknowledge the fact that the way energy.
A little louder, please. Thanks.
Yeah. Can you hear me now? Loud and clear?
Better.
Yeah. So we all acknowledge the fact that the way energy will be produced and consumed going forward will be quite different. Can you lay down your thought process from a growth perspective of the company in the view of changing landscape in the energy sector? And how do you see Thermax evolving as a key player in the entire value chain? And I think that will be very, very important from our perspective. And second, from a capital allocation, now we have more than 2,000 crores cash on the balance sheet. As you transform into the greener side, do you think more deployment of cash will go on, in projects and in JVs, in acquiring technologies? So some sense on capital allocation also would be helpful. So these are my two broad questions, nothing related to this quarterly, but more on a sense where the company is going through. Thank you.
Thank you. And a very thoughtful two sets of questions. I'll do my best to do justice to both of them. To the first one, what does Thermax do well today? Yeah, Thermax has been a player in India's energy story for a very long time. That much we all know. The unique capability that we have is understanding energy needs at an industry and a customer level, which means we are not really a broad utility-based player, but very much an industrial player, understanding all aspects of energy usage across multiple industries. Yeah, and so today that energy usage in many ways is driven by coal, it's also driven by fossil fuels, but that picture is changing now, of course. Yeah, so that picture is changing, driven by many things. Yeah, it's driven by the availability of newer models around, today you can do renewables based on biofuels, bioenergy, you can do solar, wind, increasingly storage, variety of different things that will replace what was the captive power plant of the past. Also, the economic models are changing, all of them being capex driven. Today, many of them are O&M and services driven, some of which are comprehensive. Increasingly, people are asking for build, own, operate model, solution as a service. Through all of this, I think the role that Thermax has is to be a partner to our customers, helping them through energy transition, which means the needs that the customer has. Like, how do I go about it? I want to cut energy usage. We'll have energy efficiency solutions. You want to take your existing processes, make them greener. So we can do, as I talked about, waste to energy, different kind of fuels that can come into play. as those customers graduate into wanting completely solar storage-based solutions, Thermax has to pivot to be able to offer those as well. So the whole capability around growing services in a much bigger way, adding solution capability where we have our TOSL model today, which is build, own, operate, which is growing quite well, continuing to push adding solar optics, adding solar storage to some of those solution capabilities. And then finally, in this green hydrogen world, where our capability has to come about, those are the broad areas, but all of them are targeted around helping our customers through energy transition. So that's the first part of your question. The second part is practically answered by the first, which is where will our money go in allocation? It will go towards these things. Yeah, we will add little bit for adding digital capability. We will add and continue to build our solution capability, offering utility as a service. And then finally, as we find the right entry points into new energy around hydrogen, we will look to make those and make sure that we have enough on our balance sheet to be able to make some of those moves. I hope I answered your questions, yeah?
Yeah, thanks, Ashish. I think a large part of it has been addressed. Thank you. Thank you. I wish you guys all the best.
Thank you. The next question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Thanks for taking my time. The first question is, when we look at your commentary in the last 3-4 quarters, you're saying it's a very broad-based recovery.
Can you speak up a bit louder again?
Sure. Am I audible now? Okay, so my question is that when we look at the last 3-4 quarters, you've been saying that it's a very broad-based recovery that is happening in the economy, and for you and what you're getting the orders. But when we look at you going after FGD, I think it's a big order which came from a private player which had his own issues in the past of payments. You won a very high size, good size order. And also I think you are L1 in one more FGD order which is from the NTPC. So can you help us? It's very contradictory, because if it's a very broad-based recovery, why would you go ahead and take a very low margin, very thin margin business order? Can you help us understand if the other industries, obviously there was a pent up because that our sector, cap goods, saw very late recovery when consumption went up. So is this something the other sectors now are slowly coming back to the pre-COVID kind of consumption which we have seen across sector? So if ordering something coming limited to orders like 100-200 crores, so eventually you have to fill the orders from the FGD side. Can you help us understand that? That's my first question.
Okay, I think I will do my best to answer the pieces of the question that I did understand. In between, your voice was cutting in and out. But specifically, if I rephrased your question, is around FGD, the reason to take these L1 FGD orders when we were having margin pressure on the ones that we already had. So, and why would we go do that when there is a broad-based recovery overall as well? So I'll answer that question. The fact that there is a broad-based recovery is shown in the fact that even outside of the FGD order, we are now north of 600 crores, and the next biggest order was much smaller. Yep. So even below 200 crores. So it was overall continuing to that trend that we had talked about of a broad-based recovery very much holds. We have got a few more bigger orders, or big orders, not bigger orders, but big orders also in the mix that we will see as and when they show up, depending on whether we are winning those or not. Now let me take the FGD question specifically. The first two FGD orders that we got, we were brand new in the market, and I think the overall industry in India is also relatively nascent. the pricing was set by the few NTPC rounds that happened before we entered. But because we had really good technology out here, we did want to enter into this at the right levels. And in the first couple of orders that we have taken have been a learning opportunity. I'll ask Rajendran to share a little bit more around how we look at our current set of FGDs, and of course it has hurt us in 2 quarters. The question then is, why did we go bid for the next 2? The first reason is that we expected the next 2 to be at much higher margins. To the point that when we had bid those projects, we had a margin threshold, and we had said we will not take any order below this margin. And we've always been very good, even on the FGD side, in not working with customers that have bad payment terms or are not. Even the FGD order that we have gotten in Q3 is one of the best names private players in the Indian industry. And so in that sense, it's top notch. It's nothing. And the other one we can share is with NTPC. So those are the only two orders we have taken. And when we had bid, we had expected the margins to be much better than our previous orders. That said, because both of these orders, and little bit is the nature of the FGD industry itself, because they have this long back-end approval process, we bid these orders nearly 9 months before these projects actually came to and were awarded. So the margins have actually come down on both of these orders as well, relative to when we thought we had bid those. I'll ask Rajendran to talk about. So, but unfortunately, once you put a bid in the market, you really can't withdraw it. In a name like Thermax, of course, you would want to go back. One of the projects also has a price increase clause and all. So both of these we are comfortable bringing them in. We are not unhappy with them by any means, and they are going to be corresponding to how we execute our projects. Neither one do we expect a significant cash outflow currently on both of these newer projects. The second bit I would say is that all these FGD projects, you have put an entire business around this FGD, so we need to be able to manage it, sustain it, and find what is the long-term period with it. They also provide a big role into the Indian economy by cleaning up the air. So it is not something that, so even that approach is important and relevant, and for us, which is very much in this segment, it is an important place to play. Long-term FGDs have got potential for very good services revenue as well, because all of these are plants that will then be handed over for long-term services. So for multiple reasons, we thought it was right to continue this. We don't expect to be very active on the state electricity board FGD orders, and we've been always clear we wanted to work with tier 1 entities and not beyond that. Rajendran, would you add anything on the FGD bit, specifically on margins? And long answer, but I think we should answer this question.
Yeah, so I think, Ashish, I think you covered most of it. I may not have much to add, except to state that the first 2 orders, there has been impact of COVID as well because of the delayed timeline of execution. So we would have our overheads panning out in this period, impacting us, number one. Commodity cost increase, which we I think increased during this period, which has been sort of unprecedented, which has also hit us. The third is, I think, the China embargo that I think the Power Ministry put in, of ordering some of the equipment out. So we have had challenges on that, some cost increases, and I think also a learning opportunity. So certain FOAK kind of costs have also been there. So it's been in a couple of unfortunate items that have taken us by surprise on this one. But we are working towards trying our best as it goes to full-fledged execution in the coming year to see whether there could still be some margins that we would be able to save on this front. So that's the effort that we are on currently.
Got it. This is helpful. Just second question, more of a clarification. In chemical business, even in the last quarter, it's more of a price hike than the volume growth. Even in this quarter, has there been any volume growth? It's morely large-led price, because when I see the chemical companies, they're reporting almost the volume growth to be flat, negative, whereas it's showing more of a pricing growth. Just one clarification on that.
You're talking about a chemical business, right?
Yeah.
So I think we've had volume growth as well, which you would have noticed on the back of our additional capacity at our Dahej plant, is to capacity addition that we had done. So I think the volume increase has clearly happened. But I think Ashish explained to you earlier about the sudden price correction that we faced on domestic chemicals, which we were sourcing, and I think we've had orders to execute in hand, and which wherein the price corrections could not have been implemented, and that's where I think we have faced this challenge.
Got it. Thank you very much. I'll come back in the queue. Thank you.
Thank you. The next question is from the line of Ankur Sharma from HDFC Standard Life Insurance. Please go ahead.
Yeah, hi. Good afternoon, and thanks for your time. Three questions from my side. One, when I look at your energy segment sales for the quarter, that's grown by about 9% off a fairly weak base of last year. At the same time, the order book for this segment actually has grown fairly well, last 2-3 quarters also when I look at it. And even this quarter, the order book is, I think, upwards of 30%. So, what's leading to this low growth here? Is there some, customer-driven deferrals of orders? Are we facing some other challenges in any specific large order? If you could please talk about that.
Okay, so I'll answer and I'll ask Rajendran to add also. If you remember, Q3 last year was coming from a Q1 and Q2 kind of a complete shutdown and partial recovery in Q2, and in Q3 kind of there was a bit of a release of load of finished goods that were under production and all that. So Q3 had shown a jump. When you take a look at what's happening now, is that we have seen for the last 2 or 3 quarters good growth across the board. What that has meant is that some of our shorter turnaround businesses, which is like our heating boilers and to some extent our chillers also, our services business, they are the only ones that are coming in and what is shown up in that 9%. Those businesses have grown well beyond that 9%. Meanwhile, in the bigger orders where our backlog had come down quite substantially a year ago after 4 or 5 months of COVID, there the backlog is built up very, very nicely, but they will release, most of those will go through execution and come out in this Q4 and in overall in the quarters. So we don't see any major concern out there. All the orders have been taken with some amount of thought, and we think we still have capacity to take in more large orders as well overall. So we don't see a concern. And overall, we are not. I think now we are finally in a place where execution is going smoothly. Yeah, across the board. Even on the FGD side, this is last few months have been the best from an execution point of view. Limited hiccups, the rains are behind, the China issue is behind, limited COVID shutdowns. So we are now executing quite well, and across the board, I think we are happy with overall the speed of execution now. Rajendran, would you add anything on this?
No, nothing. I think we clarified.
Oh. Okay, fair. And just on the margins as well in the energy business, again, I think, fairly weak this quarter. And you did allude to the fact that, RM prices went up, I think specifically on the chemical side, but I'm assuming you would have seen similar, impacts in energy. But more from a slightly longer term, what kind of internal targets do you have in mind on the energy business, in terms of EBIT margins over the next couple of years?
So, Ankush, I think that would be difficult to answer honestly, because we have quite a mix of businesses within the energy segment and multiple projects, and I think in some of the larger businesses. And I think to be able to give you an margin expectation on that front would be a bit difficult. So that excuses on that.
Fair. No, fair. Okay, so sorry.
If I may add, so overall, I think the energy segment last quarter also started to show a bit of a trend that we were starting to show some consistency. And I think this quarter was a little bit of a step back, but overall direction, at least on the energy segment, should be consistent. Here we will look to continue to grow that, and while our end goal we may not be comfortable sharing, certainly we expect our margins to be better than what we delivered this last quarter. On environmental, on the FGD side, on the 2 orders that we have taken already, there we will have a bit of a pressure as we release those into next year as well. We hope we can do better than what we have done so far, but until we show that on the ground and manage our remaining risks well, I don't think we can commit to anything. But on energy side, we don't see any particular worry that will prevent us from doing better. I think even the high commodity prices we can manage. It is when something goes up disproportionately within a quarter that becomes a bit of a challenge. That's it.
So alternatively, if you could help me, what percentage of your order book is on, say, fixed price contract, or and how much has a pass-through? I would assume since we have a majority on the private side, quite a bit would be, without a price variation, but it would be helpful, out of your current backlog, how much can be passed?
Yeah, across the board, I would say our services and our chemicals business, actually none of our business have got a price variation clause other than 1 or 2 very, very specific FGD orders. Yeah, other than that, maybe there's 1 other contract where I've heard of internally where we have had a price variation clause. Overall, though, on the large projects that we take in, I think we have talked enough about FGD and the first of its kind, the unique. If I take all that out, most of our larger projects, in fact, our largest project business, which is our large boilers business, it's better than expectations, has done better than its standard margins, showing great ability in both these large, long-run range businesses. To take it, what we are doing is when we get an order, and with the private sector, it's very much possible, you make sure that all your ordering happens within a very, very narrow window. So you base it exactly on the commodity pricing that you are seeing in that cycle. So most of the time we have managed it well. It's actually in our shorter cycle businesses like our small boilers business or our cooling business or our environmental business where you take in an order based on because many dealers sell it and all based on a fixed price list, and then you execute that over 3 years based on continuous inventory that is coming from vendors and all. There we have seen pressure, entirely driven by increase within a quarter.
Got that. Great. Very helpful. Yeah. Thank you so much.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to 2 per participant. For any follow-up, may we request you to rejoin the queue. The next question is from the line of Charanjit Singh from DSP Mutual Fund. Please go ahead.
Hello, sir. Good afternoon. Thanks for the opportunity. So my first question is, if you can just give us the mix in terms of, the short cycle product business versus project right now. And as the cyclical recovery picks up in the, capital goods space, these short cycle product businesses, what's the kind of growth rate trajectory which you can see going forward? That's my first question.
Charanjit, I think, are you looking for the order balance mix or are you looking for the current quarter revenue mix on the short cycle and the project breakup? Charanjit, are you there?
You may be on mute, Charanjit.
Mr. Singh, if you are able to hear us, please do respond.
Yes, I can hear you. Hello, can you hear me?
Yeah. So I was asking this the split of the mix that you were asking was on the order balance or on order.
So this is on the revenue front. If you can talk on the revenue front, and as the cyclical recovery picks in, from the revenue perspective itself, what's the kind of growth rate expectation which you can see for the standard business or the short cycle product business?
So I will just give us a few minutes. We will have to give you the short cycle orders and the project business revenue breakup in this quarter. I will let you know in some time as the call progresses. Yeah, will that be good?
No, okay, that'll be fine. Yeah. Hello. Yeah, can I go ahead with my second question?
Yeah, please.
Yeah. So, sir, and on the spares and services portion of the overall revenue mix right now, how do you see that business growing? Ashish talked about services as a portion growing in certain segments. So, in terms of overall mix, how we can see services, growing and proportion of services increasing in the overall revenue mix?
So, yeah, Ashish, want to take that? Okay. So currently, I think, as you will realize that our product and project businesses order book and order book is at a good high in terms of the domestic scenario. So the services growth that we would see would obviously be a bit muted. It wouldn't be at the levels of growth that we see in the product and the project businesses. That's because of the current cycle of booking that we are seeing. But having said that, we continue to see positive growth on the services business across all our segments, and that's doing fine.
If I may.
Yeah, sure.
So overall, I think services is one of our better stories, simply because services, each new platform that we reach increases the baseline for all future ones. Yes, so services is not one like a big order that will go up and go down. And historically, we are right now increasing services faster than and reaching newer peaks than we have ever done before. Yeah, to the point that look, right now, if you're saying have you grown services 57% the way we have grown our overall orders? No, we haven't. But is services being very profitable, very accretive on a basis of continuous growth? Very much. The focus that I would like to bring about, which is something that we look at internally and are creating a culture of looking at that internally, is take the bigger orders out, what's happening to your base business. Yeah, and the base business, which for Thermax pre-COVID would also have been of the order of 1,100, 1,200 crores, is now gotten to this point of 1,500, 1,600 crores, which is entirely driven by incremental continuous growth in services, growing channels, growing products, growing capabilities. So it may not grow 57% like a big project that comes in can result, but it does provide a lot of continuous improvement, which we really, really like.
Yeah. Thanks, Ashish. So just if I can, squeeze in one last question from my side. You talked about, rising competition in oil and gas space and even other segments. So you can, just highlight few larger competitors who are, competing with us in this segment. And in terms of when we look at the overall manufacturing capacity for some of these products, what's the kind of industry capacity utilization? Because a lot of capacities are earlier built up, but the cycle was weak. So we would be sitting on still higher manufacturing capacities for these products.
Hello.
Hello.
Yeah. Background. And your second question wasn't.
My question was on the competition. Is you have talked about increasing competition in the oil and gas space, and even in the other segments. So if you can touch upon who are the key competitors which we are seeing here, and in terms of the overall industry manufacturing capacity, what are the kind of utilization levels? Because there might be a lot of idle capacities which could be lying in the spaces of maybe boilers or other industrial components.
Okay. So to the first point, I don't think the competition has increased here. It is the same set of competitors that we have always had. So it's not but because the oil and gas projects tend to be government tendering based projects, it would be not right to speculate on what is the likely outcome of any of those big ones, which is why I said we don't know what it will come back as, but we have bid on quite a few projects. The competitors are the same ones. Yeah, maybe here and there a little bit change, but no dramatic change as such. In terms of capacity utilization, we are reaching a point where in many cases our own capacity for a certain slot or otherwise is starting to get to the point that we are getting filled up. In most of these cases, we understand which portion of that activity needs to be outsourced. We have a whole network of external partners. We never fabricate, we never get the entire boiler built out, of course, but intermediate portions, yeah, things like fabrication of very specific items, all that we will go out to external vendors for. I think overall we can manage the capacity bit right now. It's not come down to the point that we would say no to an order because there is no capacity, but that capacity availability is getting tighter and tighter. Yeah, and as we finish this year with more than 8,000 crores of orders, the run rate that gives us in certain areas and certain parts of our business, depending on the slotting, capacity is getting tight for sure.
Thanks, Ashish, for taking my questions. That's all from my side.
Yeah, Ranjit, I think we just wanted to answer your question on those percentages. So projects would be about roughly 50% plus, products would be about 30-35% plus, and the rest would be services.
Thank you. The next question is from the line of Renu Baid from IIFL. Please go ahead.
Before that, could we just share at least what is the growth rate in services as well, so that there's no on the orders? Yeah, I know if you don't have it on revenues even. Okay.
Yes, sir. Please proceed.
Okay. So yeah, with respect to last year, it's double. Okay, so services, I think relative to where we were last year, at least in this particular quarter from an orders perspective, the numbers are, I mean, close to double almost. Some services are relating to TOSL kind of build own operate, but even if you take those away, we are seeing good growth on the services side. Yeah, and a lot of emphasis and focus is also going on the services side. Sorry, to the next question, please.
Thank you.
Yeah.
Ms. Baid, you may please proceed with your question.
Sure. Thanks for the opportunity. So my first question is on solar. If Ashish and the team can elaborate on what exactly are we planning to do in the solar vertical now that a team is already built in that segment, and what would be the value addition which Thermax would be offering to its customer, or our competitive advantage or edge versus peers, and what kind of business model are we looking at? Predominantly, would it be a EPC-driven business model or similar to TOSL or utility-based service to customers in this space? And any targets in terms of how do we plan to scale up this business over the next 3 to 4 years would be helpful.
Okay, good question. Again, I think on the solar business, we have not talked about much in the past. Historically, Thermax has been playing in solar for quite some time, but our focus was on rooftop-based solar and entirely on CapEx. Yeah, so we were doing sub 5 megawatt rooftop projects for our customers, doing them fairly well, but entirely on a CapEx side. Over the last year or so, we are seeing a lot of our industrial customers coming back and saying they need more, which means they are asking for much higher megawattage. They are asking for solutions like round-the-clock storage, lot more complexity in terms of need, and most importantly, asking for OPEX kind of solutions. We think we understand the industrial customers quite well, and the use of energy at these industrial customers quite well, which means our overall capability to know how energy gets used at variety of industrial plants is quite nice. We also have fair bit of connect with these customers based on serving their energy needs for a long period of time. We understand project execution capability quite well as well, and we are not afraid of technology like integrating different elements on storage, multi-generation, biomass. Integrating all of those is something that we actually think we have a strength for, and that strength can tomorrow be taken to hydrogen as well. So with that in mind, we have changed our tack on the solar side with aggressive growth plans, putting in a whole team, which is in addition to the old solar team that we have, several industry domain experts who have spent a good chunk of their careers in solar coming to lead that forward. On the growth side, we have aggressive growth expectations, but as we grow, we will come back and share. We are not going to go do utility solar. Our focus is entirely industrial. So working decentralized but larger solar solutions for our industrial customers.
Just a bit of clarification here. So while we would be dealing only with industrial customers, you also mentioned OPEX-based solutions. So would that mean that TOSL kind of services that we are giving to customers on a build-own-operate basis, similar offerings could be looked within the solar umbrella? And if so, how do we look in terms of protecting against the efficiency levels from the solar products? Because we have seen, while customers on the utility side, the scale is different, but people who have been operating it have had problems 5 years, 7 years down the line, especially committing for the same level of efficiency levels. So how do we look at combating some of those challenges within this business?
Look, I think the first part to your question is yes, we are going to be offering TOSL kind of solutions on the solar side as well. To the second bit, the technology risk is relatively low. Yeah, there are other things to consider, and this is also potentially competitive. So there would be other risks that come with it. But the technology risk is very much manageable. Many of your, at least on the efficiency side, the products themselves come with very well understood warranties. The people that are coming in and we have got good idea. I mean, and we've been running solar plants for now well above 5 years, where we do O&M in cases. So we have a good idea of how the evolution happens on the O&M side. There now a lot of data that is available, and overall it does come down to maintaining these, using the right kind of technology, understanding the models, what is the natural degradation curve, how do you balance that off with how do you clean these panels, how do you maintain them, also what kind of projects you get into, where are these panels installed, etc. I think we can manage the technical risk. Yeah, it doesn't worry us.
Got it. And lastly, on the chemical side, while you mentioned that some of the peers have taken price hikes and we had a bit of issue last quarter, so where are we in terms of taking on the required price hikes, even oil prices have remained firm in 4Q sequentially as well? So when we look at chemicals margins, where do we see the margins heading in the near term? And from medium term perspective, are we on track for the 20% kind of margins which we were expecting?
So on the chemicals, we have done price rises. I think Ashish mentioned it in the start as well. Price corrections have been implemented in the business, and I think we should start seeing that reflecting in the quarter 4. I think, of course, the commodity cost stability in this quarter is also something that we look forward to. That's, I think, something that is something that we had to expect. However, I think on your other bit of question on margins, I think chemicals, we've always targeted better margins than what we have reported this quarter at around 11% PBIT. I think the business has an ability to do clearly 15 to 17% margins. Of course, the earlier year margins of 20 to 26% margins that we have reported were in the backdrop of lower commodity costs, and I think those may not be very sustainable. I hope that should give you the required answer.
Yeah, I think. So if I may just add to Rajendran, I think he said that what we performed last 2 quarters on the chemical side was definitely below our expectations. And this particular, we thought we started Q3 by implementing one set of price increases, but we got hit very badly by sets of chemicals, which even in this price cycle had been relatively steady, but suddenly went up. Yeah, like November, as I said, certain commodities went up 2x in price. Yeah, it was just not possible. And freight also, while we have managed to pass more and more, we were not, because we were fighting in an international competitive market. We could not pass on all the freight increase charges. We are now at a place where we have incorporated a big price rise in Q3 already. And if the commodity prices stay where they are, we hope it will stay. Yeah, but I think expecting 20-25% PBTs would be excessive. I don't think that is our aim also. We want to do volume growth, continuous, and we would like to have a profitable business which is in the 15-20% range on a continuous repeatable basis. Yeah, that's the goal for our chemicals business.
Sure. Thanks much, sir. And one bookkeeping, what is the YTD completion on the FGD old projects which we have in our backlog? That's it.
I think we've done with close to 50% at the moment on our one of the orders, the first one that we had. I think the next one would probably be somewhere around 35% or so.
Sure. Thank you, sir, and all the best.
Thank you. The next question is from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Yeah, very good afternoon. So first question is pertaining to, again, on the pricing front. When we look at it from your order inflow perspective, if one were to segregate, I know it's not exactly possible, but what kind of price increases have we taken across the board? So one were to dissect what kind of volume increase you would have seen in your new orders versus the pricing adjustment or increment that would have done for the new orders that you're bidding, how would this growth in order inflows look like? Of course, excluding that large FGD order that we have booked.
Okay, I think look, we are not comfortable sharing the actual difference because some of this is also quite competitive right now, and especially even many of our standard products. Some of this is very, very competitive information on what kind of price increases we are going through. Suffice to say that the jump we have had is a mix of very good volume growth and price growth. Yeah, so both of them have had a role to play. In coming quarters, we expect even more price growth, but the breakdown between the two, I would say they're both substantial, but without giving exact numbers right now because they're very, very important in the current scheme of things, in how we want to run. I would prefer if we don't share that. As I've stated, that it's significant volume growth as well in the numbers that you're seeing.
So, intention over here is not to understand the quantum of pricing, but more to understand the business volume growth that you are seeing on an ongoing basis. So, say if I were to ask you what would be the volume growth you would be foreseeing in your orders, say in the next financial year, probably what would you guide for that?
So overall, I think I'll see if I can, based on our backlog, give you some sort of volume growth. But I would say...
For new orders is what I'm trying to check on.
I didn't get the question. You're saying looking forward, what kind of volume growth would we expect? Is that the question?
In the new orders, basically what you're bidding for. If I were to quantify your orders in terms of volumes, what is the kind of growth you're looking in volumes, not revenues?
Okay. I think in the chemicals plant where, for example, specifically we have got additional capacity which is available, we would say at least 2/3 of the increases that you will see in the immediate set of quarters should come from volume growth. which means we expect to continue to grow this volume and utilize more and more of our chemicals capacity. Outside of chemicals, where we do, like there is nothing like a specific capacity to a plant. There is, but it's not like a continuous process. These are discrete manufacturing units where you can, and also you have got external fabrication capability and all. So it's tough to indicate what the volume growth that we expect in the future. I will repeat by saying that where we are currently at this kind of run rates in our businesses, we are somewhere between 80 and 90% plant capacity utilization, which is higher than pre-COVID times as well right now.
Fair, understood. Second question was pertaining FGD. You have given some quantum of completion of orders. If you can give a roadmap kind of how this will be ramped up over the next 2 years. So was this, say, 100 crore revenue booking what we did in FGD last year, where that number as an overall, as a percentage of revenues would stand in the current as well as next financial year, if you can guide. Thank you.
Okay, I think of the orders that we have as of the beginning of the year, which is the 3 orders that we had at the beginning of the calendar year, and now we have added a 4th one as well. But of the 3 that we have already taken in, I think this year we should finish somewhere north of 350 crores worth of revenue that we will recognize this year. And a number which is higher than this is what we will recognize next year. It will all come down to execution, but somewhere in the 450 to 500 crores is what we should expect to execute next year as well.
Got it. Thank you so much for taking my question.
Thank you. The next question is from the line of Aditi Bhatti from Niveshaay. Please go ahead.
Hello. Hello. Hello.
Please proceed with your question.
Hi. Sir, I have 2 questions. One was I wanted to understand the capacity expansions that you are planning in any of the specific segment, from the power or from the oil and gas segment that you are receiving the orders, any of the capacity expansions that you are planning. And my second question was pertaining to the heat exchanger segment, the environment process equipment segment. I wanted to understand the adoption of air-cooled over water-cooled heat exchanger, the technology adoption as such, if you can throw some light upon that.
Okay. So first, in terms of capacity, I think I've answered the question previously as well. We do not differentiate in our businesses between like an oil and gas boiler versus a boiler for a different one. We do differentiate our supply chain between large boilers and small and medium-sized boilers. So I don't think the first question as such is an industry-specific question, but in the oil and gas boilers, as I said, in portions where we have supply chain constraints with our internal capacity, we have got good external vendors for, say, a particular machine which is out of capacity. We will reach out to external partners to get that done. So overall, we don't see a big concern right now on supply chain, on the backlog that we have taken. If the order inquiry continues to be as robust and goes even more robust, it is possible in the near future we will have to think, but right now we think we have abundant capacity available. Yes, so that's the answer to the first question. On the cooling side, look, our biggest portion of the business here, which is the bread and butter, is the absorption chillers. The air-cooled condensers and the associated heat exchangers are relatively very, very small portions of our business. And even there, we are looking to become very analytically clear on what is our core capability and what is it that we will do. And there are portions of those business that are actually me too and not of interest to us going forward. And at the right time, we will make those announcements. But overall, that's such a small part of Thermax that it's not very relevant for an analyst discussion, I would say. Okay, where we are big, which is 90+% of our business, is the absorption chillers. Yeah, and there we are market leaders. And the new capacity, the new plant that we added in Sri City, all of that is for absorption chillers. Thanks. I think we are out of time as well. Yeah.
Sir, would you like to move to the next question, or?
Yeah, maybe we can do one last question.
We have one last question in the queue, sir.
Sure, we'll do
the
one
next
last.
question is from the line of Harsh from Jefferies. Please go ahead.
Yeah, hi. Thank you for the opportunity. So I just have one question. So what percentage approximately would account for of our order book and order booking from the private sector?
We don't have that number specifically. I think we should be able to go and get that number, and we will share it separately. I can say the top 5 customer orders that we have, 4 are from the private sector this time around. I think in the next coming quarters, you will see, as I said, the bigger orders on the refining side, petrochemical side, they are still not awarded one way or the other. So then, as some of those projects come into play, I do expect the government bid to go up. Right now, it's I don't have the exact number. We will get it, but of the top 4 orders, of the top 5 orders, 4 are private sector, and the single biggest order, the FGD order, is also from the private sector.
Sure, thank you. And just on the part of order backlog, approximately what would be that number, like order backlog?
Don't have the number. I think we'll share it in whichever analyst call we come to next. We will collect that information and share it.
Sure. Thanks so much.
Thank you.
Thank you. I now hand the conference over to Ms. Bhumika Nair for closing comments. Over to you, ma'am.
Yeah, thank you everyone for your time and for attending the call, and especially to the management for giving us an opportunity to host the call and answering all the questions quite patiently. Thank you very much, sir.
Thank you very much for listening to us, and much appreciated that you chose to spend the time with us. Have a great day. Thanks.
Thank you.
Thank you. Ladies and gentlemen, on behalf of DAM Capital Advisors, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.